Welcome back to NYSE TV Live, everyone. I'm Kristen Schiller here in studio at the Stock Exchange. The S&P 500 hit a new record on Friday after the November jobs report made its way to investors before trading began. Now, according to the Bureau of Labor Statistics, the U.S. economy added 227,000 jobs last month. That was higher than what Dow Jones economists have projected by a few thousand. Meanwhile, as expected, the unemployment rate did tick higher to 4.2%. Well, joining me now with more is Mark Hamrick, Washington Bureau Chief and Senior Economic Analyst. Mark, always good to see you. And as we set up this week, what is on your radar after that jobs report on Friday?
The main thing the Federal Reserve is going to want to see before they issue their announcement on December 18th, Kristen, is the duo of inflation reports. We have due up this week, and I think that even if we had some sort of negative surprise with that, a modest negative surprise, I think that FOMC officials are still likely to cut rates by 0.25% with that announcement in a couple of weeks. So, the economy, as Chairman Powell has said, is in reasonably good shape. There is too much restrictiveness associated with the Fed's benchmark rate. And not only will we get that announcement, but we'll have the summary of economic projections coming out next week as well. And that will give us a roadmap with respect to what the Fed might be doing over the next couple of years and in 2025.
What is the data telling you, Mark, about the state of the jobs market and thus the state of the broader economy?
The job market continues to cool. That's indicative or indicated by, for example, the increase in the unemployment rate moving back up to 4.2%, where it was in August, slightly below 4.3%, where it was in July. We know that last week's Labor Department numbers on job openings showed that we had a rebound in the number of jobs open, but we also had fewer people being hired and fewer people voluntarily quitting their job. So I think that this is very much in the category of normalization of the job market after all the remarkable disruptive and in some ways negative things that happened during the pandemic with respect to the imbalance of labor supply. And that supply now is in better balance when you think about the fact that we have 1.1 jobs open for every job searching unemployed individual.
Interesting. Now, inflation is expected to tick a little bit higher, Mark. How does that factor into the Fed's decision December 18th?
They've known and have seen that this is a bit of a bumpy road, and there are some components within these inflation measures which have proven sticky, as we all know. The good news is the gasoline prices were down again in the month of November. We'll see what food prices look like. We think that we'll see a decline with airline fares, and maybe even owners' equivalent rent will show less upward inflation pressure. I think we continue to have some issues with respect to prices for new and used vehicles. As we think about the impacts of the two hurricanes and flooding, when you wipe out so many automobiles through these extreme weather events, there is going to be, of course, a need to replace those vehicles, and lends some support to the price of the vehicles as well, and it doesn't help the situation with respect to insurance claims either. So there are a lot of things going on structurally that are going to be almost resistant to interest rate levels. And climate events are one of them.
A new administration, obviously, set to take the Oval Office come January, Mark, a red sweep in Washington. What does that mean for sectors of the economy that you anticipate might outperform in 2025?
Obviously, it's a very ambitious agenda, Kristen, and so as Chairman Powell has said, it's difficult to make confident predictions about the impacts of possible policy moves, particularly when they haven't been implemented yet, much less the president taking the oath of office. But in terms of things I think that we'll be watching, I mean, he has said that he'll implement these removal of undocumented aliens in the United States essentially on day one. What that actually looks like remains to be seen, but we are concerned about what the impact on that would be from, or what the impact from that would be with the labor supply. and could actually even affect things like consumer spending and the performance of sectors that are reliant on that labor, including construction, leisure and hospitality, healthcare. In terms of the sectors that could benefit, I think primarily you're looking at U.S. manufacturing there, because I think that is the one area where implementation of tariffs can lend some help to select businesses that can ramp up in response to diminution in demand of products coming in from overseas. Where it gets stickier is if you're having imports from overseas, also obviously Mexico and Canada being diminished. There are many sectors where we just don't have current production capacity. And so I do worry about, for example, the impact that consumers experience if those tariffs are put in place, where consumers then once again have their main issue that they had identified during the presidential campaign as the chief economic irritant, inflation, inflamed once again. So yeah, I think I'd put manufacturing at the top of that list. I know people are hopeful about things like the housing market. We'll see how that goes. I think that's a much more tough nut to crack because of all the complicated things that are going into low housing supply, elevated mortgage rates still, 6.84% last week on the 30-year fixed. The fact that a good number of incumbent homeowners just simply aren't prepared to move out of their homes, and so you have inadequate supply or inventory of homes available for sale.
Mark Hamrick, always great to see you. Thank you so much for joining amid a busy week here. Mark is the Washington Bureau Chief and Senior Economic Analyst at Bankrate.